Hey everybody, it's Matt. I wanted to make a video to illustrate a concept I've showed to a few of you individually related to student loan payments and savings. So many of the people I work with are trying to balance how do you pay down your student loans while you're also saving for the future and investing and maxing out 401k and IRAs and taxable accounts and just trying to achieve your goals, but you've got this dark cloud of student loans looming over your head. So I want to convey this concept to you kind of broadly and put it in video form so you can review it and go back and look at it. There's things that are confusing, ask me about it, so on and so forth. Also, I just want to note I'm making this video at 11:30 a.m. Central on Friday, September 23rd. And I don't want to appear tone deaf. I know we are having a bad day in the market amidst a bad period in the market, and I'm aware of that. But for many of you, you may be 30, 40 years away, even 20 years away from when you're actually going to need investment money, like in your retirement accounts that you can't access till you're 60 at a minimum, or 59 and a half technically, but whatever. Student loans may be a higher priority for you. They may be occupying more of your mental space than what's going on in the market. So this may actually still be pretty relevant to you. Okay, so let's get started. So some background. I sort of think of how do we attack student loans. There's three general routes that you can go. You've probably heard about, read about at least two of these, if not the third. First, you could just make the minimum payment on your student loans and invest the rest. But I've found that a lot of people are sort of not terribly excited about that strategy. It sounds like a sales pitch when it comes from somebody like me. And it doesn't satisfy, for many people, it doesn't satisfy a need to have like a really logical reason to do that other than, well, you can probably get a better return in the market. As we'll talk about later, well, you may not also. So it's not terribly satisfying. Path number two, you can make extra payments to your student loans. And a smart way to do that is by prioritizing the highest interest rate debt. So for example, let's say you have three loans. All these examples are going to be really simple compared to what I often see in terms of the number of loans and the different interest rates with actual clients. But just because I'm trying to illustrate a point, we don't need to get too complex. We can just show like a general concept, and I think you'll follow. You can apply it to your own situation. So route number two, we want to make extra payments and prioritize by the highest interest rate. So over here, these are all the interest rates for these hypothetical fake loans, and these are the monthly payments for these hypothetical fake loans. And under a strategy like what I am outlining here, your total payment is $1,750, right? So 500 plus 1,000 plus 250. So your total monthly payment is $1,750. Well, what you could do is you could say, all right, I could afford to pay $2,000. I could afford to pay an extra $250, and we're going to allocate those $250 extra dollars to the 8% interest rate because that's the highest interest rate. So we're going to attack this loan first. So this payment goes up from $1,000 to $1,250, and you pay it to that loan. Once this loan is, and you're making the minimum payments to these. Right, so your total payment is now $2,000 with the extra $250 going to this loan. Once this loan is completely paid off, okay, now we start over. So once it's cleared, we're going to still pay the same $2,000, right? So we're not going to lose this $1,000 minimum payment that we are already paying. We're going to pay the same $2,000, and we're going to allocate to the excess to the 7% loan. So this loan was crossed off. It's completely done. So now your minimum payments are $500 and $250, so that's $750. But if you're keeping the same $2,000 payment, you're paying an extra, whatever that is, $1,250. Sorry, mental math. You're paying an extra $1,250, and that excess payment is going to go to this particular loan, and we're going to pay it down until this one is crossed off, and then you're left with the lowest interest rate loan, and you're keeping the $2,000 payment. And so instead of paying $250 every month, you're going to pay $2,000 towards this, and that is a nice way to get rid of the highest interest rate debt first, the 8%, then the 7%, then the 6%. You maintain the same payment over time, and it just gets more and more powerful as your loans get reduced. I sure hope I did that mental math right. If I didn't, don't worry. I use calculators and software when doing my actual financial planning. Okay, so that's, I would call this sort of like, this is beginner, and this is, I don't know, intermediate. What I'm about to talk about, maybe sort of advanced, and I'm not trying to like brag about it or something. I'm just saying I don't know that I hear this strategy being used in a lot of. Okay, so the third general route. Sorry, that's not it. That's the first general route. The third general route is to integrate your payments with your investments. So, in my opinion, this is a really, dare I say, beautiful way to go about doing this, because it's going to be, I think it's going to satisfy many people's need to have like a super rational, logical way to go about balancing your payments with your investments. And it kind of combines the other two ideas a little bit. So let's just say you have an average loan rate across all your loans of 5%. Now, I want to be clear that in my experience, if you have federal loans, your average rate is higher than this. If you have private loans, you refinance prior to interest rates jumping up, your loan rate is lower than this. So I purposely picked this sort of intermediate number just to say, just use it as a frame of reference. I know that it's probably not accurate. On purpose, I put it between federal rates and private rates that I'm seeing right now with clients. But let's just pretend your average loan rate is 5%. The traditional wisdom might tell you, okay, stocks may return 8%. So if you're balancing, I can get a positive return of 8%, or I can get a guaranteed return of 5% by making extra payments on my student loan debt. Well, pay the minimum to the student loan debt and invest the rest, because you're going to capture that 3% excess return in the stock market. Well, there's a couple of problems with that. You're probably not 100% invested in stocks. So stocks may return 8%, maybe. But you may have other investments like bonds that are probably not going to return 8% or may not return 8%. Not all stocks have the same expected return. I put expected return in quotes because I want to be very clear that expected return does not mean, in this scenario, in this context, it is a financial term that is based on a mathematical formula. Expected return does not mean just what it means when we're talking about expectations out on the street, walking around. This is like a financial term. So just be aware, when I say they may not have the same expected return, it's not me saying, oh, I expect stocks to return 5%. That's not what it means. It's a mathematical answer. And I also shouldn't just say stocks. Not all investments have the same expected return. So it doesn't necessarily make sense to just use the aggregated average total return. And then the third reason that this traditional wisdom may not be that great is that debt, excess payments on debt is a guaranteed return, where stocks and even bonds are not guaranteed. So if you make an extra payment towards your debt, you are retiring that debt. You are no longer going to pay interest on that debt, and you have guaranteed yourself the interest savings that you otherwise would have paid. So for all those reasons and probably more, the traditional wisdom just doesn't always feel right. It's not necessarily terrible advice or anything, but it's just, I know a lot of people are unsatisfied with it. Okay, so to try and save some time here, I'm just going to go ahead and load up the next circle, the next slide. All All right, so let's look at what this might look like in practice. So let's say that you have a loan, or your average loan rate is 5%, just like we said on the previous screen. And let's say that you've got a portfolio of stocks that is expected to return 8% over time. Okay, well, so that's like too simple of a way to look at it, in my opinion. You may not have pure stocks. Let's say that you have, for the ease of math later, let's say that you have 74% in stocks and 26% in bonds. I'm going to write that. Actually, you know what? I'm not going to write that there because it's going to get written on later. We're just going to leave the 74% in stocks. Let's just say you have 74% in stocks, 26% in bonds. Okay, so immediately, here's your 8% expected return for stocks, which people have been referencing against the 5, saying, oh, well, it's better, you should be over here. Okay, well, what if bonds are only expected to return 4%? Well, now maybe this looks like a better option for you to pay down the loan relative to bonds. And in reality, there are many different types of bonds. There are many different types of stocks. I'm just trying to keep this clean so I'm not divvying up the pie chart to a ridiculous fashion. But let's just say you have 3 different types of bonds. Maybe you have U.S. Treasury bonds that are guaranteed and have no credit risk, and so they offer a lower interest rate. Maybe you have corporate bonds issued by investment-grade corporations that offer a higher rate than U.S. Treasuries backed by the government, but maybe they're not quite as high of an interest rate as compared to high-yield bonds, or what are called junk bonds. They are below investment-grade status, and because of that, the investor is, theoretically rewarded with a higher interest rate. Okay, so now when we look at it, we say, all right, well, this changes the math a little bit here. We expect our stocks in aggregate to return 8%. Remember, there's more nuance, but just for the sake of argument, 8%. We expect some of our bonds might return around 6%. Some of them might return around 4%, and some of them probably going to return somewhere around 2%. Well, now this is a very different calculation. And so we could say, all right, well, why don't we replace this 2% yield? This is not an allocation. This is 2% expected return or yield. This little slice of the pie, instead of putting our dollars there, why don't we think of our loan payments, where we're getting the guaranteed 5% return on excess debt payments? Why don't we put that sleeve right here? Why don't we swap that out? So instead of using the fund, mutual fund, ETF, whatever, that we would use to occupy this slice of the pie, why don't we consider our loans for that slice of the pie? And so the way that would work is, first, you start with your minimum payments to the loans. Okay, so going back to our original example, I don't even remember what the total payments were for the original 3 loans, but just start with your minimum payments to all your loans. Then, whatever excess savings you have available, plan to invest it. Plan to put it into a portfolio like this so that you can grow your retirement. But the next step, the third step that makes things a little bit different, is the dollars that would otherwise go into this slice of the pie, take those dollars and allocate them to the loan, where instead of getting the 2% expected return, you would get yourself a guaranteed 5% return on the excess dollars you're using to pay down debt. So the reason I used 74% stocks in this example is so that I could get to, you know what, we're going to change that. That's actually going to be 76% stocks. Really having a tough day with my mental math. 76% stocks, that means this is 24% bonds. And if we just said these were equal allocations, that's 8% here, 8 and 8. So if you're going to invest, let's say $1,000 into your investment portfolio, well, 8% of it is going to go to this sleeve here. And so that's $80 that would be going to your excess loan payment. And I'm using $1,000 as a starting point. Maybe it's $1,000 a month. Maybe it's, $50,000 a year. Whatever the number is, we would just allocate this portion to excess payments on your loans, and it gives you a really clear, logical way to determine exactly how much you're going to pay in excess payments to your loans, how you're going to balance the loan payments with your overall investment strategy. You're coordinating these two things seamlessly, and I just think it's a really nice way to go about doing it. Okay, so let me get rid of that. And then let me walk through some risks, because it's always important to talk about what the risks are. So, importantly, money put toward your student loans is gone. So once you make those excess debt payments, that money is gone. You're not going to get it back. For anybody out there that's aware that if you paid your student loan payments during the pandemic, you can request a refund. That's technically true, but that's not what I'm talking about. Just in general, money put towards student loans is gone. So it's not liquid. You can't get it back. If you have some sort of emergency and you need cash, it's not going to come from the payments you put towards your student loans. If you need to rebalance your investment portfolio, the money that you put towards student loans is not available to do that. So if stocks are down and bonds are up and you need to rebalance and add more to stocks, the excess cash that you put towards student loans cannot be used to do that. And just I put et cetera here. Basically, it's just really important that you understand that once you pay towards a student loan, that money is gone. So you don't want to go overboard with a strategy by allocating too much of your investment portfolio to the student loans. So the way that we manage that risk is that we maintain an adequate cash reserve. So that'll be something separate from your investment portfolio. And then second, we only replace a portion of the bonds because we want to leave some for rebalancing. So if you remember on the prior screen, there were 3 different slices of the bond pie, and we're only allocating student loan payments to one of those slices. The other 2 are still there and available for rebalancing purposes between your stock and bond allocation. Secondly, there's an opportunity cost. So maybe there's going to be even more future forgiveness. Maybe it will turn out that instead of getting 2, 4, and 6% returns in your bonds, that you would have gotten 4, 6, and 8%. And now this isn't such a great deal. It's just a risk you take. It's an opportunity cost. But I think a lot of people are willing to accept that opportunity cost in return for just the guaranteed return by not paying interest, by not paying as much interest on their debt, and getting rid of that debt burden just hanging over your head like a dark cloud. And finally, it's complex. So I am a financial planner and I manage people's investments. And so this is something that's pretty straightforward for me to calculate and do on behalf of clients. But if you're not somebody that is going to hire a financial planner or outsource the investment management, then this may be too much of a headache for you to deal with and keep up with. It's one thing to go through the exercise at the beginning and make the decision about how to do this, but it's another thing to keep up with it over time. So it is more complex. There's a few more moving parts to it, but those are the risks as I see them. I'm sure there are more. It's not a comprehensive list of all risks, but I think it's a pretty good list. All right, so in summary, I'm just going to go back to the picture. So what we're going to do is we're going to first make the minimum payments on the loans, and then we're going to allocate the excess payments. That we're going to take the portion of the bond portfolio that has a lower expected return than the interest rate on your loans, and we're just going to take those dollars that would go into this sleeve, and we're going to allocate them to paying excess payments on the student loans. All right, that's it. I hope this was helpful for you. Like I said, I recorded it so that you can rewind and stop and go back and ask me questions. Hopefully I didn't make any major errors in my math, but hope it's helpful, and let me know if you have questions. Thanks a lot. Bye.